This is brought to you by John Daniel and Partners LLP.
I can see more people have joined, so I think we can start with the presentation. I would like to introduce the presenter or the speaker of today. The speaker is our managing partner, Dan, and he has over 25 years of experience in this field, and so we believe he's the best fit person for him to discuss this matter. So if Dan can hear me, Dan, you can unmute and start with a presentation. Thank you.
So welcome everyone, and I'm happy to be sharing with you what we have basically prepared in terms of the implications of the Finance Act in what was passed after the budget for 2023-2024. So what we have done is we have done some analysis in terms of the issues that are most relevant for small and medium businesses. There's a lot, of course, that goes into the Finance Act, but we have tried to distill as much as possible to bring in what we believe are the most relevant issues, and probably the newspapers or the media does not emphasize on those areas. Because as you'll understand, sometimes politics overshadow the main issues that may be affecting us individually. So we will be focusing on the implications of the Act. And we'll basically have these four areas for four sections. We'll be looking at the general issues, just for us to understand the background, then focus on the changes in the Income Tax Act, or areas that have to do with income tax, and then VAT. And then there are also other very important issues that were put in, and they affect us as individuals and as business people. So if you are managing a business or you own a business, we want to use the common man language. We want to discuss using the ordinary language. So it's not technical, and this may disappoint those who are technical accountants. Using a sometimes very what we consider to be ordinary language, yet to somebody else it's jargon and it would be difficult to understand. So we are basically trying to bring in the common language so that we can be able to understand it as much as possible. When we talk of the Finance Act, also good for us to understand, especially this year, because politics made the Finance Act look like it is something unusual. But Finance Act or Finance Bill initially is something that is prepared every year by the government around June, and the process starts much earlier, where the government gives estimates to Parliament and its policy directions. There are so many things that are done long before, including even public consultations. But of course, what we usually get in the media, it sometimes focuses on the major things, and therefore, because of the push and pull in politics, the Finance Act for this year was relatively kind of exaggerated in terms of the attention it got. I'm not in any case trying to downplay the issues that were there, whether they were grave or not. I'm just saying because of politics, the way competitive politics are in Kenya at the moment, it became very important what Parliament was discussing. Good also to mention that the validity or no validity, or whether it should be there or not, there is also something that is in the before the court. And I know there's even a decision that the Court of Appeal will make tomorrow. So we are not going into the issues of discussing whether which side is right, which side is not right. So we are just looking at the contents, and why are we doing this? Because we want our clients, our business people to understand that whether the Finance Act is allowed or not, those issues will affect you. And even if they are suspended, the government or governments will always try to bring in. If they are defeated one side, they'll also bring in and correct whatever anomaly was there and bring it back. So it's not that you are going to escape. It's only probably postpone if at all the people who are opposing the act are going to succeed. So our issue is not to support or not to support whichever side. Our focus is on what are the contents and how do they affect somebody running a business or somebody involved in running a business or planning to start a business. What are the implications? I think those are very important issues so that we are able to appreciate in a very neutral way, what the government plans to change or plans to put in. Of course, the government is looking towards financing its budget. We know that government gets money from us as individuals, as business people, from everybody else who is importing, whatever business activity you are carrying out, whether you are in employment, whether you are exporting, or in some cases, with their levies, taxes, all manner of things that are charged so that the government can get money to run its budget. So for this year, the budget was huge. It was huge. So we are talking of 3.67 trillion. And that has to be financed by you and me. That's, of course, nothing unusual. That's the way the world operates, whether we are in Kenya or in the US or whatever. Governments tax people, and from the taxes, they are able to finance their own operations. The only other alternative is borrowing, and of course, to some extent, we have been borrowing. And even for this year, there's a whole budget deficit of 824 billion, which is a huge amount. So that will be financed through borrowing. That means the government will borrow money from banks, from donors, from even individuals. You and I, if you buy treasury bills or treasury bonds, you are lending money to the government, and that is the way the government finances its operations. So it's a huge thing, and we probably don't need to worry so much at that level, at the macro level, what I would call macro level. You probably want to worry so much about your business because the philosophy you can use is what happens will happen to everybody. If the taxes are passed and everybody has to pay taxes, then it's everybody. So our worry should be at the individual level. At individual level, it will be very at individual level. It will be the businesses that will be affected, and every business has its own unique issues. So if we just have a comparison with what Kenya has in terms of budget with the Tanzania and Uganda, you can see Kenya is has a bigger kind of a bigger budget. And this, of course, has been the case throughout. It's nothing new. What we probably need to ask ourselves is whether it ought to be that big a budget, especially when it's to do with the borrowing. And of course, sometimes it's good to appreciate that when it's a budget, it's an issue of how ambitious you are as a country, and whether you can implement those ambitions is important. But again, as I've said, as individuals, we'll be affected as individuals and not collectively so much as a country. So the government will want to raise income taxes, will want to raise VAT, will want to raise all manner of taxes. What we need to know is we will get to contribute our part, and we need to look at it or ask ourselves, how can we be fairly involved, so that your business does not pay an unfair share of taxes. And unfair, I mean you are penalized or you are forced to pay interest because you didn't know. And if you didn't know and you suffer, that is that's an ignorant, that's the ignorant side, because you didn't know, but you've been penalized. Of course, you can cry and say it's quite unfair and everything, but lawyers will tell you that ignorance is no defense. So it's important that we know, and that's why we are having this session. So let me start with the income tax part. And as I said, I'll try to use very ordinary language so that we all appreciate not to be very technical. Now, first, and probably to me, one very big milestone, and something which in my view, the media has underestimated, is the fact that all expenditure for a business will only be recognized by the law as expenditure in terms of taxes if it is processed through electronic, what we currently call ETRs, but now which has gone electronic. And there is a system that KRA has called Electronic Tax Invoice Management System, ETIMS. So in other words, if you are recognizing a certain expense, then that expense has to be linked to a certain PIN, which has to go through ETIMS. Now, this has huge implications. It has huge implications. And if you think about it, what does this mean? It means if you have a transport company and that transport company has provided transport to my business, so to me that is an expense, transport expense. But for me to recognize that transport expense so that the taxman is happy, then your invoice has to go through ETIMS. By implication, it means your invoice, which is your income, is known to KRA. So every expense the mirror image of that expense is income to the other party who provided that service or that product. So we will all be connected through the taxman as business people. And I believe you can see why I'm saying this issue has not been given due attention by the media, because the implications are huge. It means in terms of accounting, we have to be very good at accounting for our expenses through e-teams. We have to ensure that all our expenses are processed, or we are only dealing with the people who are going through e-teams. It also means we have to be very perfect in the way we do accounting, in the way we keep our records, so that those records can match what KRA has. Of course, there are a few exceptions to that, and the taxman has provided that. And the effective date for that will be January next year. So it may take some time to be digested. That's assuming the Finance Act will still be allowed to go through. And even if it's postponed, I'm sure it will continue. The government, or whichever government is in power, will try to bring it back, because this is where we are heading in the long run, because this is what the developed world has always done. And because nowadays there are electronic systems that are able to link one another, so we will basically be operating in a place where you cannot hide your expenses, you cannot hide your incomes. So that's very important. That's a very big thing. I've taken time to emphasize on that because I believe it's a very important part of what will affect many, and especially small and medium enterprises, because they usually don't have their accounting systems right. They usually don't do accounting properly. So again, in record keeping, you'll find many people with records which are in notes, notebooks somewhere. Somebody left it at home, or a small exercise book somewhere. Payments which are just going through M-Pesa, and maybe they are not linked specifically to the business. So those are things that we need to consider and ask ourselves as business people what we need to do about it. How can we be able to improve our records? Because as I mentioned there earlier, we can be able to shout about how the government is unfair, how the government is overtaxing. It will happen to everybody out there in the streets, in the media, social media, and everywhere. But only your business will be affected as an individual. And of course, KRA will approach you as an individual. It does not go to the streets or try to justify that in a public rally. No. The KRA will come to you and tell you, this is about the much we know you have made, and this is about the much we expect in terms of taxes. Then there is also reduction for corporate tax for non-residents. Probably many of us will not be affected, as we are residents, but there could be a non-resident or two, or somebody who knows a non-resident, and therefore will have something to do with that. So the new rate for corporate tax is 30%, and from that 7.5%. Note that this is for corporate taxes, and the definition of resident is not the same as citizen. So it's important we emphasize that there's a technical definition which is there in the Income Tax Act. Turnover tax, which affects very many small and medium enterprises. The turnover tax rate, and this is for small businesses, usually the ones that are not registered for VAT, and they're also not paying income tax in terms of arriving at a taxable profit, and therefore putting a certain rate, which is usually 30% for a company. But turnover tax is for somebody who is eligible or somebody who is under that category will pay turnover tax. So it is no longer 1%, but 3% of the turnover. Note here is on the turnover. And it's very important to know the turnover is basically all your total sales, all the sales that you have. Then you take a pass. It was supposed to be simplified tax. It was supposed to take care of somebody who is not bothered with the calculations of what are the expenses, what are the total revenues minus expenses, how much, so many technicals. You just take the total of what you have sold, then you multiply that by 3%, and that's in every month, and then out of that you pay the tax money. Now, note that also the upper threshold has been reduced from 50 million to 25 million. So if you are total annual, that's the yearly turnover, is up to 25 million, then you can pay turnover tax. You can opt to pay turnover tax. Now, the important bit here is to know that this is not a very big amount if you think about it. It's not a very big amount. And it will be, it's probably about 2 million. Okay, for a small business, of course, is a lot, but many businesses will have turnover that goes beyond that very easily. Even small businesses, especially the ones that have very low margins. That means you are selling like a distributor. If you think about a distributor of soda, a distributor of soda from one bottle gets a few shillings. So you'll have to sell a lot for you to get some good profit. So there will be a lot of sales or a high turnover, but very low profit. So getting to that level is likely to be, getting to 25, it likely to be very, very easy. Now, note that it's not always an advantage to have turnover tax instead of income tax for somebody who has the option of paying income tax. Because even if your business is operating at a loss, if you are under the turnover regime, then it follows that you still pay tax at now the rate that has been increased from 1% to 3% of the turnover. So it's important you consider that. Then introduction of digital tax. Digital tax has been introduced, and there was a lot of hue and cry in the media. Digital tax asset. This has to do with what nowadays we are calling cryptocurrency. There are also things called non-fungible assets. There are a lot of things that have gone in the modern technology has brought in. So a digital tax, the easiest thing to explain for somebody who may not be familiar is falls like the cryptocurrencies fall under that, is a digital tax. So if you are transferring ownership, that means like you are selling bitcoins. Bitcoins are the most widely known. If you are selling bitcoins, that transfer, and then whoever is operating that platform has a duty to deduct with the 3%. Then reduction at the rate of residential income tax from 10% to 7.5%. This was said the intention was to promote compliance. So residential rental income tax, I know that one affects people who are landlords. So, and again, rental income, there are so many things or so many matters that you need to consider. Because rental income, there is also the option of opting out of the rental income. If you are exclusively getting rental income, you need to consider whether you need to pay rental income tax, or you need to notify the commissioner and opt to be under the income tax regime. And those are things which can be handled by an accountant or a tax advisor, somebody who understands the technicalities. And usually these matters are on a case-by-case basis. So one may not be able to recommend and say rental income tax is usually better, or income tax is usually better. It depends on the individual's circumstances, the matters that are unique to you. How much are you collecting? How much are your expenses? And that can only be discussed at individual level. Of course, I had emphasized this bit about compliance, e-teams. This I cannot overemphasize this issue, but it is important to take it seriously. It will certainly affect us, and in very many ways. So if you are prepared, the better you'll be. The more prepared you will be, the better for you, because it will mean you have put your house in order, and therefore, even if the taxman is allowed to proceed with the Finance Act, then you'll be in a good position. And of course, the taxman's work would be easier, kind of, because our meeting point, everybody doing business, it means our meeting point is in Kerry. We are transacting any business transaction. Basically, that's the way it means. Any business transaction. I'm selling to you, therefore you are buying from me. As we do the exchange, then it will follow that KRA is in the middle, or is basically aware. Of course, there are many people who can raise other issues about privacy, about invading. I mean, one should be able to do business freely, but whether now or in the near future, but we are heading there. That's where the world is, and the developed world has already done that in very many ways. So proper accounting, proper record keeping would be very important. There are also other issues to do with income tax. So like interest expense, it has now been restricted to 30% of earnings before interest, taxes, depreciation, and amortization. That term is like just saying from ordinary profit. Let me use that word, ordinary profit. Whatever you have earned before you deduct interest, before you deduct tax, before you deduct something called depreciation, before you deduct amortization and all that. But the excess can be rolled over to the next 3 years, assuming the subsequent years you don't get to that level of that percent. The aim here is to reduce people who are or businesses. Remember, this affects non-residents, and non-residents. You could be funded heavily by somebody else. So if you are doing business in Kenya, Kenya may not be benefiting. That's the purpose of this. And the same with that bit of the realized foreign exchange losses. Foreign exchange losses will occur if you are trading in foreign exchange. You are trading in dollars, in euros, or whatever foreign currency. So the exchange between when you buy and when you invoice and when you get paid, the changes in the rate between that foreign currency and the Kenya shilling, that's when we have losses. And sometimes there are also gains. So in this case, for non-residents, there is there is an allowance that you can defer those losses if they exceed the 30% again of what I was calling ordinary earnings. To just try to use the common man language, which is earning before interest, taxes, depreciation, and amortization. Now, the other bit is about digital content, withholding tax on digital tax monetization. Now, this brought a lot of uproar in the media and generally social media, because young people are feeling like they were being targeted, because this one is affecting many of our young people. So if you are being paid, if there is any payment that is related to this, then whoever is paying you, we need to withhold 5%. That's the implication of this. And withholding tax is not anything new. It has been there for a long time. It's just a way of the taxman trying to get money as soon as possible in a more reliable way. So instead of you being entrusted with the whole amount and then you pay, then whoever is paying is mandated to withhold a certain portion, which in this case is 5%, and send that 5% to the taxman. So digital content monetization is already defined in the Income Tax Act based on the amendment that was introduced by the Finance Act. So, and here they are defining it in terms of offering payment for entertainment, social, literal, artistic, educational, or any other material electronically. You are offering a payment electronically through any media or channel. And here we are talking of websites, content creation, promotions, subscriptions, e-books, membership programs, crowdfunding, the new terms that people are talking about nowadays about the cyber world. So, or new ways of making money, those who are making content in YouTube, whatever, all those things, then it follows that at the point of receiving money or receiving the payment, is withholding. Now, note, this is income tax. And when a portion has been withheld, it doesn't mean that that's the end of it. It is you to look at how much you have earned and then how much you should pay, and then deduct what has already been withheld. Just like for somebody who gets employment income, pay as you earn is kind of is a form of withholding, because the employer withholds that and pays to the taxman, and then you are expected to file the return at the end of the year to show the total that you have earned and how much you have paid and what is due. So it is a very, it is, of course, when you are touched, that's when it is seen to be a big issue. But somebody who has been paying withholding tax will find it ordinary. It's only that some people are being brought to the same table to do with the withholding. Now, there is also a new provision or a kind of an adjustment to make it, to encourage startups, what are called startups, or small businesses, which are young. And basically that young means not more than 5 years in existence, according to what has been put in the Finance Act. And then a company which is with less than 100 million turnover, which is quite, in my view, a generous assessment of a startup. And then here, the encouragement is for that startup to include its employees in its ownership. So if there is an employee ownership scheme for a startup, what the Finance Act is saying, you will. I mean, if somebody opts to pay employees with shares in lieu of the emoluments or the salaries that would have ordinarily been paid to that employee, you opt to pay with shares, then there is deferral of taxation. That should tell you, of course, that payment via shares will be better by default instead of, and of course, these are shares of that startup. And the aim is to ensure that employees participate as owners of that company. So if company X decides that your salary is this much, but instead of paying you 100% monthly, a portion of that, we will be selling shares to you so that you on an incremental basis, you become part of ownership of a company. Then that amount that you contribute to buy shares will not be taxed. And of course, there are also conditions on that. If you leave employment, then the tax becomes due. The aim here is also to assume that when you have shares, you are contributing better in terms of the adding value to that company. And remember, the value of the shares will also increase as you contribute to the ownership as an employee, or if you are employees, if you are an employer, if your employees are being paid, probably their participation is more engaging. They are putting in more in terms of their participation. They feel they have some sense of duty, not just as employees, but as owners, present and future owners of the company. So it's something which every SME should consider, and I think the mechanics of doing that, of course, will require advisory setting. Will require to process certain documentation to ensure that you comply with all the requirements. And of course, there are also policy issues that you need to decide as a company. For example, how much will a shilling be worth in terms of contributing to a share? You have to consider the seniority issues. If somebody is senior than the other, what can that person earn more than the other? How much can the employees buy 100%, or what percentage can be bought of the company by the employees? Those are things that you may want to discuss or debate with your team and probably the shareholders, and then you set to what as good policy, and of course with your advisors, so that you can finally set what a good arrangement. The tax rates were changed a bit, and I would not say a bit, because the aim here was to add more other levels of tax, because the highest tax rate was 30% initially, but the government thought that if you are earning up to a certain percentage, then you need to contribute more. So if you're earning up to around 500,000, I think is 500,000, yeah, then the highest rate will be 30%. Above that, the next 300,000, you'll be taxed at 32.5%. If it is above 800,000, then it means your tax rate, any amount, any shilling you get for the extra that shilling, you'll pay tax at the rate of 35%. Now, Besides that, of course, there is what has captured the media's attention, like the housing levy, which is 1.5%. There was a huge discussion, and when the bill was in Parliament, there was contribution, and then the amount will be kept. You'll get a refund after 7 years. Of course, in the course of those discussions, finally, Parliament settled on 1.5% of gross salary as a levy. Now, note this is a levy, and a levy, you are not getting it back. So it's just a contribution. And of course, the pros and cons of this, if you never get a house, you'll not be very happy about it. Maybe whoever gets a house will be celebrating, but not everybody. You can be sure, of course, not everybody will get a house. It's not practical. The aim is basically for many to contribute, and then the few deserving cases, we can debate the night over of whether who is deserving and who is not, because that will be a different area. So this amount again will be paid by both the employer and the employee. So the employer contributes, the employer contributes. Now, the implication of this to business people is that this will be a huge expense, especially for those with many employees. Think of a company, a private security company, for example. A private security company with 1,000 people is not a very big one. Because 1,000 employees for a private security company is not a very big company. But if we are talking of 1.5%, how much is that? It translates to a significant amount for whoever is going to pay on behalf of that employee or that group of employees. So this is an important thing, and this was supposed to take effect from July, and of course, because of the suspension of the Finance Act by the court, we don't know whether the salary for July will be affected. But to me, maybe I think tomorrow's decision I think the Court of Appeal had promised to make the decision tomorrow in terms of whether to suspend or not. Then that will determine whether July salaries are affected. Of course, there is the issue of subscription, club membership, which does not affect many small and medium enterprises. But there is also the issue of the car benefit, which has now gone to in terms of how much one is to be paid, that will be determined by the rates given by the Automobile Association of Kenya, AA of Kenya, AA. We usually know them as AA. And so the way they decide in terms of how much or what size of a vehicle is supposed to be paid this mileage, or in terms of shillings per kilometer, those rates are the ones which will be used to determine a traveling allowance for employees. The other bit is about withholding tax on, I think I've talked about digital content. There is also withholding tax that's falling under sales, promotions, marketing, advertising services. Previously, withholding tax was only falling on consultancies for, say, training, for management consulting, advisory kind of stuff. So the taxman is trying to bring more people into the bracket of withholding tax. And as I said, this withholding tax is just trying to get the money as early as possible. Then withholding tax, once it has been withheld, then you remit it within 5 days. Now this is a huge thing, because withholding, if you withheld on 1st, Previously, we were withholding. If you withhold on 1st of the month, you have the whole month until 20th of the following month. You have literally 50 days. If you withhold in making the payment on 30th, you have a whole 20 days, because the deadline for filing and paying withholding tax was 20th, or it has always been 20th of the following month. But now this is changing, so it's 5 working days. The taxman is basically telling you why you stay with the money for that long if already you have withheld, and there is some reasoning to it if you can think about it, because the purpose of withholding is for the government to get the money early. So one person withholding and paying after 50 days, nearly 50 days, then it may not. That's a maximum that has always been there. But again, I don't want to get to that debate of whether it's good or bad. For me, I want to leave it to Parliament and the courts to decide. Once they decide, then it means for us as business people, our duty is to comply. And of course, if you don't comply, you'll be penalized. And KRA may not get you today, but if they get you tomorrow, you pay the penalties. And as an individual, that's the philosophy that I would really recommend that we work with. Then there are also other changes, like contribution to a post-retirement medical fund. Now they are allowable. Then there is also a provision which is supposed to guard against or trying to deter transfer pricing arrangements. Transfer pricing arrangements are those arrangements where if a company is operating in different jurisdictions, let's say in Kenya and Uganda, some businesses will, or even people register companies. Even you register a company in Mauritius, for example. Mauritius is considered to be a low tax place, as it kind of falls under the categories that talk of tax havens. And there's a big discussion about those tax havens. But the people who make those decisions, they make them consciously, maybe for certain strategic positions. Maybe they are doing international businesses. Maybe they have relationships with the subsidiaries, with the holding companies in those jurisdictions. So in the course of trading between related companies, sometimes organizations either underestimate the revenues or inflate the costs or inflate the expenses. And that's where the issues of transfer pricing comes around. So to discourage that transfer pricing, whatever the commissioner considers subject to corporate tax, the arrangement that you have in terms of whatever will be withheld, it doesn't matter. So it's basically giving more leeway to the taxman to be able to go for those arrangements. And because of internationalization of business, trade, in many respects, it has happened that many businesses or people, even a small organization, somebody will just talk to a lawyer and they get their business, a similar business registered in Mauritius or any other country. I'm not in any way trying to be against Mauritius. But those decisions, once they have been made, sometimes they are made purposely to reduce on the tax liability in Kenya. And therefore, the taxman would want to be against that. The other bit is the capital gains tax. And capital gains tax was introduced some years back. And capital gains tax happens when you you sell certain assets, and when you between the difference between the price you bought the asset at and the price you are selling at is what we call a gain. Let's say it's a piece of land. You buy a plot today, you hold it for 2 years, and then you decide to dispose it. You bought it for 1 million, but now you are selling it at 1.5 million. So the extra 500,000 is a gain. And of course, you'll be allowed to reduce some expenses like the legal fees or certain fees, that expenses that you have incurred, to reduce so that you get what is called a net gain. So there are certain indirect transfers. Indirect transfers are basically people, when this capital gains was introduced, people started coming up with other ways of avoiding it. If, for example, instead of transferring I'll give you an example. If a company owns that piece of land, let's say a company owns a piece of land, and then that piece of land, instead of selling it to company B just buys shares, 100% of company A. That's an indirect transfer. In other words, company A owned the property, and let's assume for simplicity that's the only asset the company owned. Then company B, instead of company A selling the land to company B just buys all the shares of company A. And the company is the only asset it has. And then it follows, there is an indirect transfer. So that again will be subject to tax. People are doing that just to avoid the payment of capital gains tax, and especially when significant amounts were involved. Again, there are people who are inflating the costs, and so the rules to avoid inflating of the costs have been adjusted. A due date has also been adjusted. There are certain provisions that to ensure that when you receive the money, that money is that capital gains is due. And again, you are not restructuring, because there are exemptions to do with the restructuring, like if you are restructuring a company and there are capital gains. Now, let me as I close to, I come kind of close to, I am approaching the finish, and at this point I'll ask that you remember to put any questions, comments you have in the chat box, and I hope my team and I mean Mase and I think we'll be able to check, and I think also Chris will also be able to check if there are certain things we can also answer, and or to confirm something you'd want us to confirm, or even a specific question relating to a particular business that you feel we should guide you with. You can put it there, then we can be able to look at it and probably respond to you in the course of this seminar, or if you are not, we can be able to come back to you in a different setting. But I want to discuss a few things that were affecting the VAT. And of course, this got a lot of attention because of because VAT has being an indirect tax. It's a tax that is placed on something. Then that effect, we call it inflationary. It means it increases the price of whatever you are buying. So first there is fuel, and of course that you know very well how it has affected the fuel prices. Then there was the relating of LPG, and I think the gas prices are supposed to have come down. I'm not sure they have. I don't know. I probably need somebody to make a comment there if you know it has come down. And then aviation, removal of VAT for aircraft parts, engine, basically to support the aviation sector. And some of these tax changes, of course, the government passes because they target certain specific things. Like, for example, to rescue Kenya Airways or some other airlines, local airlines, such things. The government can take certain changes just to support. Exportation of services now zero rated. This has been to and fro. There has been exemption. There was a big discussion about what exportation of a service is. I'm not sure this debate has ended because if you think about it, when you do something online for somebody and you are in Kenya and that person is in the US, is that export of a service? You have to travel to the US to provide the service. Those are the huge debates that happen, and that's why the definition of export of a service is not an easy thing, and it has brought a lot of cases. What you probably would want to know is about your particular business and how you can be able to support with evidence that your services are being exported. And of course, nowadays, because of high tax and the issues of e-teams, it has become also very important that because there are certain codes that you have to use that will basically be able to show is an export. So there are some things about refund. If you have done business and it was a bad debt, somebody has not paid you for some time, as you try to chase the debt, there's some VAT that you may have paid. So in this case, you are the recovery period has been extended from 4 to 10 years, which is good. Threshold for VAT registration does not apply to digital tax platforms because the threshold for VAT has been 5 million for a long time. So as the digital tax asset matters has come, as those matters have come up, then nowadays the taxman is saying that the issue of 5 million does not hold. So you need to register for VAT if you are operating a digital tax platform. Then zero rating of tea and coffee purchased for value addition for export. This is basically to promote export of processed tea and coffee. And I hope that will affect the tea exports in a positive way, and the coffee, which are significant exports for our country. Now, let me go to some changes which are also very important, and these changes are especially very important for somebody who is running a business or somebody who is planning to do a business. Now, if you have done international business and there was tax due in another country, running into Kenya, you'll not escape. That's basically the implication of that first bullet there. What we are saying is the tax money, and this is basically out of international agreements between Kenya and other countries, because Kenya would want also to recover tax that anybody who has evaded tax and has run to another country, then Kenya would also want to follow that person to that other country. So because of international agreements, it follows that Kenya has obligations to deduct taxes and hand over to that country, just the way Kenya would also want whoever has disappeared with the tax then to follow up that person at that country, deducts and remits to Kenya. Those who are operating trustees, and trustees are again operated a lot by those people who are operating tax havens. I'm not saying tax trustees are for avoidance of tax all the time, but sometimes they are formed purposely, or they are registered purposely so that they operate in those tax havens, and then they own some things in Kenya. So KRA would want to follow up that, and therefore it has been empowered to get all the records. So if it asks about any trust that somebody has, whether it's operating in Kenya or outside Kenya, then KRA gets those powers. Now, something big that has been introduced, very big in my assessment, and which I would really urge almost every other business to consider, is the issue of tax amnesty. And those who have been aware about taxes for some time, if you remember during Kibaki's time, around 2004, 2005, Kibaki government introduced tax amnesty, which contributed a lot to tax collections. And of course, every government would want to collect more because politicians, they make a lot of promises to their people when they are being elected or when they are seeking election. When they get to office, what they look for are resources so that they can be able to fulfill those promises. Whether they meet those promises or not, it's not an issue for this forum again. But what we need to know that every government needs money, and that happens everywhere. So in this case, I know there has been a kind of a tax amnesty which was not very attractive as such, because it was only kind of forgiving. Let me use that word, forgiving. It's called remission, and in technical terms. So waiving or not refraining from collecting taxes that are due. So tax amnesty will really benefit somebody who is trying to put his or her house in order. So in this case, they have put a tax amnesty. If you had taxes and you had paid all those taxes by end of last year, but there were some penalties or some interests, what KRA calls additional taxes, that were due, then you'll get kind of, you have an amnesty. That means KRA will not bother to collect that. Of course, there are conditions on how to go about that. But if you want to take advantage of that now, you need to apply. Maybe you had not paid your taxes. Now remember, and here it's good to clarify what a tax amnesty is. Tax amnesty will never forgive what is called the principal tax. It will never forgive that. It means, because that's KRA's money, or not KRA, it's government's money. So what will be forgiven are the penalties for not filing and filing the returns and paying those taxes in time. So in that case, you can apply, or the business will need to apply and come up with a payment plan and ensure those taxes are paid on or before 30th of June next year. To me, that's a very good arrangement. It's a very good arrangement, which I think is a good arrangement, and especially if you connect it to what I had said about e-teams. It's something that any business would want to take advantage of, so that ultimately the house is in order. So I really urge that can be done I mean, one can be able to organize himself or herself so that you can take advantage of that. The taxman can recover taxes by registering with the Register of Rands. That's another thing that has been introduced. You need to be careful, because it means the government has more, it has an advantage to recover more. it has actually been empowered even now to file what is called an agency notice and recover immediately all taxes that are due. If you have filed a return and you have not paid certain taxes, it will be easier for the taxman to just get an agency notice. Agency notice is where the government just appoints, say the bank, money in the bank, the government appoints your bank as your agent and asks the bank to pay you money, to pay it money that was due as taxes on your behalf. So those are things that need to bother us and to ensure that our taxes that we may have filed and we have not paid, what are we doing about it? Or any assessments that we had not objected to within 30 days as we are required to do by the law. So again, the taxman has also been empowered to kind of come up with a document management system, a document data management system that can have electronic documents. This is huge, again, is huge in that instead of KRA telling you to bring a file to Times Tower, or if you're in Mombasa, to the office in Mombasa, if you're in Nakuru, the office in Nakuru, then they'll just tell you, just attach a document somewhere, or just deposit that document somewhere, and it will be very easy for them to operate efficiently and confirm whatever you are saying you did. So those changes, in conclusion, we are saying we need to put a house in order, basically improve our accounting, and take advantage of the amnesty if you are trying to clean up. And of course, you need to be well guided. So in that case, I would really urge that you talk to a professional and a CPA firm like ourselves, and you can use your I mean, whoever advisor, make sure you're getting advice from the right person, so that you consider your business in a very stable way. Let's remember that taxes apply to everyone, and it's very easy to say collectively, no, we are not going to pay, no, we are. But when it gets to tax compliance, that will affect you individually. KRA will know your PIN, will know your mobile number, will know your email or your business as a business. And it has all the powers provided in the law to come for you. So you need to be careful to ensure that you are in good hands and you are really taking care to comply with the law. Let's also be positive about taxes. And it's usually not a very easy thing to do, but I think it's a good philosophy if you think about it, because taxes come from income. So as you derive the income, then the tax is a consequence. Is a consequence. Tax is a consequence of income. So you need not to worry so much about taxes as long as you have income and you have put your house in order. We usually worry about taxes, like Income Tax Act, if you don't even know how much we are supposed to pay. And we will not know how much you're supposed to pay if we have not done our accounting correct. So I think it's for our benefit that we put our houses in order. So I would want to conclude at that point, and probably I know I've taken a bit long. I was trying to be as thorough as possible based on the short time that we have provided for in the webinar. I would want to know whether there are certain issues which have been raised in the chat, and probably also ask my colleague Chris if they are to have gone through the chat to see whether there are specifics that we require I know I had a problem with the sound at some point, but I hope it became I hope I became clearer with the time. So I think I would want to hand over this to Mase now. Thank you very much, those who have been our participants, and we really appreciate your involvement, and we really want to continue educating our clients and our future clients, both current and future clients, so that we can add value to in the society that we live in. Thank you very much. Mase, over to you.
Okay, thank you. Thank you so much, Dan, for such a wonderful presentation. You have really tackled the topic well. Tax is a broad area. I know probably we cannot capture everything in one sitting, and so we would continue, or we would want to continue to have such conversations with our participants and SMEs specifically. And so I am on the chat section and I can see a question that has been raised. I would want to take it back to you, Dan, for you to be able to answer that question. The question is from Sally, and the question reads, what about failure to file new returns? Can I apply for waiver? Chris, you can unmute and help me answer that question. If you can see, the question reads, what about failure to file new returns? Can I apply for waiver? She says she failed to file new returns for the last 2 years. Yeah, so welcome, Chris.
Hello, everyone. For that question, everyone is entitled. It's up to you now to convince KRA that you need those penalties should be waived. Now that the issue here is you can do the application, which is rightfully you are right to do that, but then you'll have to prove to KRA that you really need to have the penalties waived. But in considerations with what happened after they withdrew the reliefs that were there, I think it will have now to take a little more time, but it's still possible to have those penalties waived. Remember, they only put it on hold. They did not entirely stop the process.
Okay,
Thank you,
Chris.
I've answered that to Sally.
Yeah, I can see she says yes, she's answered. So thank you so much for clarifying that. Do you have any comment, Chris, before I move forward?
I think Dan did a very good presentation and covered all the areas. If business, as a business community, we adhere to these small issues that were raised in the budget and also the Finance Act, I think we'll also be in a good position to be able to. Right now, the government is aiming at collecting and increasing the revenues that they have been collecting. So they'll try to get revenues almost everywhere they can. So it's up to us as a business community to stay up to date and also to have good accounting procedures, so that in any case they'll come for a demand, we are already prepared for that. That's all, Mercy.
Okay, thank you, Chris. Yes, it's up to us to comply. I know it's not easy to comply with KRA, but it's a mandatory obligation for all of us as business people to comply and even listen or join in such a webinar so that you can learn on what is expected of you as a business person. Most of us do not comply because they are not aware or don't know what really they need to. Yeah, so if you have any question to do with tax, or if you have any tax challenge or any finance challenge in your business, feel free to contact us at John Daniel and Partners LLP, and we'll be able to meet with our experts, and we'll be able to walk with the journey with you. I can see from the chat section, Kiprotich is asking for VAT and Income Tax Act in PDF form. I will be able to share that after or tomorrow. Yeah, Danex says, I joined late. Can I get a recording of the session? Yes, you will get it. I'll be sharing that also to everyone that joined today. Yeah. Yes, Sally says, I think serious sensitization needs to be done. Thank you for the presentation. You're welcome, Sally. Yeah, and I agree with you. We need serious sensitization on all the areas of taxation, because really they affect all of us and affect businesses. Yes, I would like to end it here. But before I end it, I would like to tell you more about John Daniel and Partners LLP, who exactly we are. Most people confuse us with a law firm, and no, we are not a law firm. We are an audit firm. I would like to present something.
Something I can contribute, Mercy, a bit. Sorry, as you put up the presentation.
Okay, thank you.
I noted about Gilbert asking for a PDF of income tax and VAT acts. Yes, we will share that, but we'll share through a link, which is basically KRA website, which is, in my view, the most updated. Versions, if I may say, because what happens is that with every change, with every year that there be changes in the Income Tax Act. Income tax is a very old act. I think it is a 1974 act. So it's an old law that is changed every now and then, So sometimes you can get a copy of, let's say, 5 years ago. And therefore it may not be having what has been changed since the 5 years when it was published. So in my view, the best thing is the KRA website is usually the best. They may not update in time, and that's why it's good to be conscious of what the Finance Act has given. And I think also the Kenya law, I can't remember exactly the site, but they also give updated one. But the KRA website for tax purposes, I believe that's the best. We can share that link, and you can get all the tax acts that you may want to refer to there. That would be my comment. Mercy, you can continue. Thank you.
Yes, thank you, Dan. I hope you can see, all of us can see my screen.
Yes.
Okay, yeah, so we are John Daniel and Partners LLP. We are an audit firm. And as I said, we are, in Nairobi, here in Kilimani. And we mainly serve clients from across all industries, be it manufacturing, schools, any industry we are able to serve, because for us we are a core, we are support system in any business. So we believe in teamwork, integrity, and excellence when we are serving you. So when you come to us, you'll find we really embrace teamwork and integrity. And as I said, our main reason as to why we're in business is to empower businesses run their or concentrate on their core businesses or core tasks. Yeah, so as you all know, accounting or tax, finance is a support area in every business. So our aim in business is to help you run your businesses in such a way that you're able to concentrate on what you do best, and as a result grow. And so we are happy when you see you succeed, and that is what inspires us most. As I had said earlier, our services include accounting services, bookkeeping services, internal and external audits, tax advisory services, and management advisory services. So in case your business needs such services, feel free to contact us here at John Daniel and Partners LLP, and we'll be able to help you. Our team or our business, John Daniel and Partners LLP, is comprised of a team, and the team is a multi-talented team, which is all round, and mostly we are young professionals and young talent, and we are CPA finalists and zero advisors. I should have mentioned before or earlier that we are using an accounting software that is known as Zero Accounting software that is best for every business, and specifically for most or for all SMEs. Yeah, so if you have a business and you not have a software, it's good that you get a software which is cloud-based. That means you can access your financials from everywhere. Be it when you are on holiday or you are at home, you can access it and continue to work and monitor your progress. So we've served quite a number of clients from all industries, including Bata, the government merge systems, Groots Kenya, Untapped, EcoPrime. All these this is just a selected or some of the clients that we are currently serving. Yeah, and they cut across all areas. Yeah, so when you come to us, we use this approach, which is we first need to understand your need, because all the clients that come to us do not have the same need. Yeah, so we need to first understand your need. Then if we are able to solve that need, when we are able to contract you, we plan on how we are going to deliver, and then continue with discussion and consulting with you and maintain that relationship. For us, we really treasure our relationship with clients because for us, it's not about giving you accounting services, it's not about giving you audit services, it's about the relationship that we have with you. It's about seeing you grow and prosper in the market. And so that is basically John Daniel and Partners LLP. If you want to know more about us, you can go to you can go to our website, that is www.johndaniel.co.ke, or you can also find us across all social media platforms, including Facebook, Instagram, LinkedIn, Twitter, Pinterest. You can find us in all social media platforms, and you'll be able to get us and also learn. We post a lot of inspirational and also content that you're able to learn from, including on the industry updates such as the Finance Act and the budget. So please ensure that you go to check us on those social media platforms and our website, and we will be able to continue to work together and build the relationship. So thank you so much for coming to today's or joining into today's webinar. Remember, we have these webinars every month on different topics that affect SMEs. So as I told you, please keep look into our website and social media platforms. We'll be putting across the next topic of discussion, and also be sharing our recording, and we'll be sharing the recording of today's discussion for us to continue to learn. You can be the ambassador of our webinars. We now have rebranded them to Wezesha SME series. Wezesha is to empower SMEs, or Wezesha is in Kiswahili, or in English, Wezesha is to empower. So we aim to empower you as an SME through the knowledge that we have on business consulting. So you can please continue to share that information with your friends and invite them to these webinars, because we have seen them being impactful to the businesses, to most of the businesses, for those that have. So thank you so much. So thank you, Kiprotich. Hope to see you next time, or next webinar. Thank you, Mark. We were saying thank you for the informative session, and we are also saying thank you for joining. So asante sana, everyone. Have a good evening.
Thank you. Same to you.
Thank you.
This is brought to you by John Daniel and Partners, LLP.